Let's talk about today's action in our closing bell exchange with Aaron Gibbs from S&P Capital IQ. We got Leo Kelly from High Towers Kelly Wealth Management, Ken Mahoney from Mahoney Asset Management, and our own Rick Santelli there at the CME. Aaron Gibbs, we're halfway through the reporting season on earnings. How are we doing so far?
So far, so good. It's looking really good. You know, we started the quarter at a little about 0.5% growth. We're now up to 3.5% growth. So it looks like we're going for Q1. So it looks like we're going to hit that usual peak of 4 to 5% above analyst estimates. So we're looking nice. The downside is all this growth that we're getting in Q1, they're just taking it away from the remainder of the year. And the annual numbers are still holding steady.
So you think we're front-loading the year?
That's what the analysts are tracking right now. We're really ratcheting down the second half of the analysts for the estimates. For
I thought it was the opposite because I thought we were expecting more growth in the fourth quarter.
And we are, but as the first quarter is coming in, when it's basically been raised about 4% in growth, those have come pretty equally out of Q2, 3, and 4, and we're still at 7% growth for the year. That really hasn't changed.
Leo Kelly, what do you want to do here in terms of allocating capital? How are you invested?
Well, I think it's a time right now to exercise caution. The market has moved significantly in a short period of time. Long term, we're bullish. I don't think you can come out of equity. Long bonds, they're just trouble waiting to happen. So what do? Alternative investments. There are liquid alternative investments that clients can get into. There's a scarcity of capital in that market. I think now's the time to exercise caution, despite the Fed and the ECB and the Bank of Japan and every other central bank in the world just throwing capital at this market. Sell when it's high, buy when it's low, take caution in the middle.
Okay, so you're cautious. Ken Mahoney, though, you're sticking with the good old-fashioned low-volatility, high-yield stocks that everybody loves right now, right?
Yeah, you know, it's one of those things that seems to be working at the moment. But, you know, I would say, though, I noticed a character change last week. The Dow down 260 points on Monday. Tuesday bounced a little bit and down again on Wednesday. And I think the culprit's earnings. I mean, last quarter to this quarter, S&P earnings are up 1.5%, and we have stocks up 10%. So it's got to be resolved, and it seems like there's some type of bubble between the two. So it's either earnings are going to start accelerating and meet and support those stock prices, or stock prices are going to come down and meet those earnings.
What do you think happens?
I actually think we're fairly valued. Right now, we're trading at about 14 times forward earnings. So that's still fairly depressed off of historical levels. I think we could still see a little more appreciation in the year. But again, I'd like to see the earnings growth come through. And I don't think that's going to come through anytime soon until we get rid of this, this wall of worry. And then finally, when we see the annual estimates come up, I think that's where we can see some real appreciation.
14 times is totally reasonable.
Yeah, exactly.
Historically speaking, yes.
Yeah, exactly.
When you consider where we've been.
Yeah, we're well depressed.
Rick Santelli, jump in here. What do you see? What's the action looking like today in Chicago?
Well, 166 yield. I know our first guest said, stay away from bonds, but wasn't that long ago we were at 2%. It's been a decent rally. The lowest yield closed since December 11th, and next week's a big week. ADP and jobs report, both hovering in the 150s, but also, obviously, the Fed meeting. But one more thing, we get the May refunding quarterly announcement on Wednesday the 1st by the Treasury, and look for them to brag up big time the big revenue receipts because we had the tax increase. Now, granted, when you increase taxes, a lot of times the first year cycle is big, then it moderates, but that will affect, it's already affected the amount of bills that are going to be auctioned. It's lower, and we'll see if there's any guidance for the quarter by the Treasury for things like maybe products like floating rate notes they've talked about, so you want to pay attention on Wednesday, and for the Fed and jobs reports, two of them next week.
You also had the European Central Bank meeting. Are you expecting them to cut rates as everybody else is?
I'm going to go against the grain. I think Merkel, with her two-speed economy in Europe, when she talked yesterday about if it was up to Germany alone, we'd have to raise rates versus what's going on in Southern Europe. I think it's going to be talked about, but I don't think you're going to see it in practice.
Leo, if we don't get a rate cut from Europe next week, what do you think our markets do?
Well, I think our markets right now are hinging on what the Fed is doing. And listen, revenues are going down. We're seeing economic data starting to slow in terms of momentum. And I think gold is telling us something. Gold is telling us that everything is a little bit weaker than maybe expectations are. So I don't know that the ECP, other than one-day trade, is going to affect our markets. Right now, it's about, can we turn this thing around, get revenues going again? Because the earnings cuts can only go so far. Look at gold. I think it's telling you to take caution. Long-term, buy equity.
Did the GDP report tell us anything today? I mean, I know it was below expectations at 2.5%. However, it's much better than what we saw last time, which was 0.4%.
It tells us that we're better than a crisis. It tells us we're coming out of maybe a short-term interim pullback, but we're not there yet. And I think we have to all put this in perspective to where the market is today. We're 130% above the bottom.
You know,
Go ahead,
next week, Rick said next week is a very busy week, of course, with economic data, but let's not discount the sell in May and go away. You know, for many years, professionals spoke about sell in May and go away, but the last couple of years it really worked. I mean, European debt woes came to fruition, and now people on Main Street are talking about it. So as we turn the calendars over next week, let's not discount the sell in May, go away. Some people may get a little bit cautious about that and be like a kind of a collective self-fulfilling prophecy we may have.
You know, on this GDP report, I'd just like to weigh in a bit. I know 2.5 is no 3.2, but I'll tell you what, I still think even at 2.5, that this number makes the first quarter appear much healthier than it is. I think you have to look at the weakness over-exaggerated in the fourth quarter, the growth in the first quarter exaggerated, and look somewhere in the middle. I think when we get done with this quarter, I have a feeling we're going to be closer to the 1.7 to 2.2 than we are to 2.5.
Wow. Well, that and the Fed can only double its balance sheet so many times.
Right.
That's true. You still like financials, yes?
Yes.
Why? Rates are so low right now, it's tough to make a buck in that industry.
Well, one of the reasons is, one, they're just trading at much lower valuations, and we've actually seen the biggest growth and the biggest revisions both for Q1 and for the year coming into financials. We just think the expectations are for them. Another thing is we also still really like the REITs. There are quite a few, not always necessarily single-family homes, but multifamily homes, the rentals REITs.
The rental market's very hot right now.
It is, and those are some that are really pushing really well. One of our favorites is Avalon Bay, and it's definitely one of the areas that we're looking at.
Do you think we're going to see a lot of regulation change the banking sector, though? I mean, are these banks going to look the way they look today in 5 years?
Oh, I doubt exactly.
3 years.
That's 5 years tough. They're definitely. I'm sure there will be regulation changes, but I'm not expecting big ones going forward.
Too big to fail?
Yeah.
You don't think they'll sell assets? All right. Thanks, everybody.
We're there, yeah. Thank you, guys.
Appreciate it.
Have a good weekend.
Thank you.
We'll see you soon. We're in the final stretch here. We're picking up some steam here.